Hey everyone, this is Rahul with the Alternative Investors Hangout, and today we have a returning guest. He is Alistair McLeod. He's over at financeandeconomics.org, and also you could find his work at goldmoney.com. Thanks for coming on again, Alistair.
It's my pleasure, Rahul.
Okay, we saw a huge plunge in the price of gold. This happened on the Boston Marathon bombing day, and then it happened the Friday before as well, and I think the Thursday as well. Anyways, what, in your opinion, is going on right now? Ron Paul has stated in a few interviews he's not sure who had that who held that concentrated position with the sell order during those days of that raid. He thinks that it could be due to the Treasury. Your thoughts?
Of course, the whole point about market stories is we don't know if they're true, we don't know if there's any basis in them, and so on. And markets, people spread rumors to achieve an effect. So we don't know whether it was real or whether it was a rumor. Certainly nothing, as far as I can see, showed up in the Comex volumes. But then, it could have happened in London, where, of course, there's nothing recorded. As to what it might be, I think that there is evidence that the central banks and the bullion banks are getting quite frightened about the lack of gold around. And I think the intention was to shake out holders in ETFs and presumably also in allocated accounts in the bullion banks in London. So really, I think the whole purpose of it was to upset investors, convince investors that gold wasn't going up and that they should sell. And to an extent, it worked. But of course, then there was the other side of it, and that is the people who are genuinely worried about the system collapse, hyperinflation from all the money printing, whatever it may be, all around the world turned buyers of bullion. They saw it as a never to be repeated chance to buy some cheap gold and silver.
Yeah, you see a lot of demand for gold and silver right now, and part of it's reflected in the premiums, part of it is just-in-time inventory issues with the mint. But I wanted to go into a further topic. Many guys are saying, A, there's a silver shortage. I don't quite agree with that. I think there is a just-in-time inventory problem. And then 2, a lot of people are talking about a Comex default or a CME default or LBMA default. And I interviewed David Morgan, this was over a year ago, and he said that they could come up with many tricks up their sleeves in how their contracts are written up. It could be that these guys aren't going to get their gold. They may just get compensated in cash, or they may get their gold delivered at a future date. Morgan didn't say this, but Warren Buffett received his silver quite late when he bought it in the late 90s. So could there be a Comex default in your opinion, or is David Morgan onto something? So speaking of Chicago, do you maybe see the CME going under because people start taking delivery in the near future and probably the destruction of fiat money? People are going to be scared of holding their cash, so they're just going to take delivery of gold and silver, or no?
Not particularly. I mean, I'm not addicted to being right. I'm addicted to doing my best effort for everyone's benefit. There's so many rules in place that favor the shorts that I don't see that happening as much of a likelihood, and let me explain. The rule has been in for a very long time that the most anyone can take on silver is 1,500 contracts in any given delivery month. So that means 7.5 million ounces. And right now there's 35 million ounces, last time I checked, and that was recently, of the dealer inventory. So that was roughly 5 delivery months in a row. Well, before that ever happened, they've got a lot of things they could do. So as it got squeezed, let's say someone made up their mind they're going to do it, okay? They never get to the end game, in my view, because the CME would come in and say, well, we changed that. Here's the rule. You can only take 1,000 contracts. No, you can only take 500 contracts. No. And then, of course, they could close the exchange, read the rules. I don't think they do that, which is what you're saying. Would they do that? Or could they do that? That's a better question. Could they? Of course. Would they? Don't think so. What they most likely do would be make a rule change and say, you know what, unless you have a fully paid for contract, you've got to settle for cash. You get these green pieces of paper, and why would you complain about that? So I doubt it, but I wouldn't rule it out.
I think it's quite possible that various players in Comex will be unable to deliver gold or silver. At the moment, the focus is very much on gold, and I think that there is a greater shortage in gold than perhaps in silver, if only because with silver, of course, production and scrap comes to 1,000 million ounces or something a year. So you've actually got a bit of a flow on silver, but in gold you haven't. And I think David Morgan is absolutely right in suggesting that they can come up with all sorts of things to, deal with any particular situation. And we have seen some evidence of that, I think, in the last 2 or 3 weeks. I think there's another point which people don't fully appreciate, and that is they look at gold as 2,750 tons of supply. There is jewellery scrap, which presumably at current levels is a net contribution, if you like, to supply. So call it sort of 3,000 to 3,500 tons a year, and they think, well, that's the market we're dealing with. But they're not. They're dealing with a market of 160,000 tons. That is what we at Gold Money estimate to be the total gold stock. And people who own it on a rise may be sellers, but on a fall they may add to their positions. There will be other people around the world seeking to add or seeking to acquire gold for the first time. It is an enormous market, and I think this was the miscalculation. If the fall in prices, the recent fall was an attempt to shake stock out. The analysts think in terms of a 3,000-ton market, and actually they should be thinking of a 160,000-ton market. And this is why I think that they were overwhelmed by buyers of the physical on the price knockdown. And there is another aspect of this which I think is equally important, and that is that the East places a higher valuation generally on gold in their paper currencies than we in the West place on gold in our paper currencies. Now, what this means is that there is a continual move of gold away from Western markets, which is where the capital markets are, to the East and perhaps even to the Middle East. And this is the source of the shortage of bullion we have in our markets. It has all gone to the East, and that is really what the crisis is. Basically, by mispricing it in the West, we've driven it all abroad. So that, I think, in a nutshell, sums up what the position is. And I think the central banks are in an extremely difficult position on this because they can't get the gold, if you like, to support the bullion banks, who undoubtedly are very, very short in London because they run a fractional reserve banking system with gold. And, of course, you've got the situation in Comex where there is a short position, and it's just so interesting that the commercial banks wanted to, the bullion banks wanted to wind down their positions. I think, they believe there's good reason why they should reduce their exposure, and that's what we've seen.
Yeah, I mean, if you look at what's going to eventually happen, all over the world, they're debasing their currency. And it seems that the price of gold is going up in other currencies right now, especially the yen, the British pound, where you're at. But in America, you don't see that happening right now. Why don't we see higher prices in terms of dollars? I mean, yeah, we know that the market's manipulated. It's always been manipulated and rigged, but it's, I don't know, 1450. Shouldn't it be 2,000 above that?
Well, yes, I mean, the fact is it's not 2,000 above that. I think that this continual drift of bullion out of Western capital markets will eventually force the price up. And I think when it happens, it's going to be very, very dramatic. I mean, just think of it in terms of how the bullion banks are getting more and more geared. We don't know how much the central banks have supplied to the market, but some very interesting work by Eric Sprott, when he looked at customs statistics of the United States, showed that non-monetary gold has been leaving the United States at a considerably faster rate than either it was imported or indeed being mined in the United States. So there can only be one source of it, and that is the Fed. And I think he estimated that the amount that's gone could be between 4,900 tons and about 11,000 tons. That's from memory, reading his paper. Now, I find that very interesting. I think it's the first tangible evidence we've had, other than rumor story, the admitting of gold leasing operations by central banks. Because the thing with leasing operations is you don't know if the position's been properly closed. This suggests it hasn't. So the central banks very definitely have disposed of quite a lot of gold. So the idea that there's roughly, I don't know what the latest figure is, something like 29,000 tons held in central banks. No, it is not. I mean, there may be more undeclared gold held in eastern central banks like China's and so on, but the western central banks, I think they're running out of firepower, and I think this is a real crisis in the market. And if I am right, then this is probably the most destabilizing way in which derivatives markets could upset the whole apple cart.
Ron Paul talked about what you were saying, that essentially central banks are price rigging right now, or price fixing, and it reminds him of the 70s where they were able to get away with it, and even the 50s and 60s where they pegged the price of gold at $35 an ounce. But then it broke down. Is an immediate breakdown in the works right now, or do they still have time? Because if you look at it, gold has gone down only, I don't know, is it 30%, 25 to 30% from the highs? If you look at the 70s, gold went to $200 an ounce roughly, and then it went down to $110 an ounce. So there was a 43% retracement.
Yeah, I think it's a bit of a mistake to look at it that way, to compare the situation today with the 1970s. What we're talking about, after all, is not the gold price going up, but the purchasing power of paper currencies going down. Now, I know that in the 1970s there was a growing concern about hyperinflation, but having lived through the markets in those days, I can assure you that the production of money by the central banks was not on the scale, it was nowhere near the scale we have today. Today, the central banks are having to print money to stop the banks going bankrupt. They have to keep interest rates down, otherwise collateral values start collapsing, and we know how bad the balance sheets, the true balance sheets are of the banks, and they have to print money so that government can go out and pay its bills. And this is Weimar Republic stuff. It is nothing less than that. And it's not just dollars, it's yen, it's pounds, it's euros. It is everywhere. Every paper currency, which after all depends for its valuation on the user's confidence in it, they're printing it at an accelerating rate. It is extremely alarming. So I think it's a great misnomer to try and look at the price action of gold relative to the 1970s. The situation today is completely different, and I would urge everyone to stop thinking in terms of the price of gold going up, but start understanding that what's actually happening is that the intrinsic value of paper money is going down and going down. And it is unless that for some reason they manage to get off this money printing kick, logically these currencies are going to get destroyed.
I hope you're wrong about the hyperinflation, but I wanted to change gears, and last interview I told you that I wanted to get into debunking some Keynesian topics, and Keynes, and then you had guys like Krugman talking about Say's Law. And for those that don't know Say's Law, basically savings and investments are vital for the economy, and then Keynes and Krugman, they really don't believe that. So what are your thoughts about how Keynes trying to debunk Say's Law?
Well, Keynes came to the subject with attitude, I think, is the best way to put it. If you read his general theory, which is generally regarded as his greatest work, to me is the greatest load of rubbish anyone's written. But anyway, we'll put that to one side. In his concluding chapter, he stated that he looked forward to the euthanasia of the rentier. Now, the rentier is a slightly sneering term for saver. And he then went on to say that he looked forward to the day when the entrepreneur was not over-rewarded for his effort. And indeed, most entrepreneurs, so far as he was concerned, were entrepreneurs because they liked what they were doing, and that should be reward enough. Now, this is communism. So really what we have is we have a man who is trying to persuade us of his economic theories, but he comes at it with a very, very socialist bent, and I don't think that's generally appreciated. And as for Mr. Krugman, the title of his column, as I understand it, is The Conscience of a Liberal. Now that's political, isn't it? And I think that's really where these guys are coming from. It is not sound economic theory.
Yeah, I'm with you on there. And they would argue that you need consumption, and they're talking about also the government coming in to try to solve our problems. And they would say, hey, look, in the United States, the government came up with these highway systems in the 50s. That added to economic prosperity. And then they say, oh, the government created the Internet, or they laid the foundation with DARPA. So how would you react to when these liberals or Keynesians come up with arguments like that?
Well, it's really quite simple. I wouldn't say that every bit of infrastructure spending a government does is wrong. Sometimes, I have to say, it's usually by accident they get it right. I think where they can make a contribution without screwing it up too much is in sensible things like road construction, the provision of, I don't know, sort of electrical highways, that sort of thing. I think they can do a certain amount of good without involving too much harm, because there are always two sides of these things. But of course, the problem is that any apologist for government intervention is only looking at one side of it. They're looking at what they see. This is the Bastiat thing. That you can see the road and you say, there is a road, that is a good thing. What you don't see is the money that was taken off people by government in order to build it. And what you don't see is what people would have done with that money if government hadn't taken it from them. And that's always the important point to consider, which nobody actually looks at. And it's an extreme version of this myopia, is when people say, well, if we have a good war, it'll demolish a whole load of buildings, and then we'll have a building boom. Fine. But actually what they're not doing is they're not looking at who is going to pay for the building boom at the end of the day, and they're not looking at what could be done with the existing infrastructure by people. They're assuming that it actually has no value, when it does actually have value. It is there for a purpose, and the purpose is decided by ordinary people.
Right, and what they would say is, hey, there's a savings glut, and then they always ignore what you talked about, Bastiat's broken glass fallacy, and Henry Hazlitt also wrote about that. And before I let you go, Alistair, how can people follow your work again?
Well, I write regularly on goldmoney.com, and really, at Gold Money, apart from providing a service, custody outside the banking system, which I think, with systemic risk, is going to be increasingly important, we're really all at heart believers in sound money. And I think that's the theme behind the economic articles, the articles on economics that I write. Though also we try and inform people about the markets, gold and silver, and of course we've got James Turk with us, who has been in this market for an awfully long time. He founded the company, so I think actually that the Gold Money site has got a lot of relevant information for people looking to protect their assets in the future. But I also have my own site, which is financeandeconomics.org, O-R-G, and sometimes when I write something which is not for Gold Money, you might find it there.
All right. Thanks for coming on again, Alistair.
That's my pleasure.